Welcome back to the deep dive. So, you're trying to navigate the California housing market. It feels like facing two huge forces, right?
hmm
Home prices just keep climbing, and then construction costs. Well, they make even a basic remodel seem kind of scary, financially speaking.
Yeah, absolutely. It's a
Yeah.
tough environment.
And you've come here looking for maybe a smarter way, a structured path to fund a home remodel, possibly using, federal help.
And that's exactly what we're aiming for today. This deep dive is zeroing in on the FHA loan limit. And really importantly, that specialized FHA renovation program, the FHA 203K loan, particularly looking ahead to 2025.
Okay.
Our mission really is to pull out the key facts. What are the expected FHA limits, county by county? And crucially, how do those numbers let you actually fund the upgrades you need, even if, your income is moderate or you don't have huge savings?
Okay, let's unpack that. Starting right at the beginning, we hear this term FHA loan limit thrown around. But what is it exactly? Why does the FHA get to set a maximum number?
It's fundamental. The FHA loan limit is simply the highest loan amount the Federal Housing Administration will insure in a specific place.
Insure, not lend.
Right. The FHA doesn't give you the money directly. Private lenders do that. But the FHA basically promises the lender, hey, if this borrower defaults, we'll cover your loss.
Ah, okay.
And because of that guarantee, lenders are, more willing to work with borrowers who might have smaller down payments or maybe need slightly more complex financing, like these renovation loans.
So if FHA is just the insurer, why the geographic limit? Why not just one big national cap? Wouldn't the banks still carry the initial risk?
Well, they set these limits because the loans they back have to reflect the actual property values in that specific market. The FHA's whole point is making home ownership accessible for regular folks, moderate income buyers.
Oh, right.
If they set the limit way too low in, say, San Francisco, nobody could use the program for anything decent. But if they set it super high in a really low-cost area, they might encourage, risky lending, people borrowing more than the house is worth.
So the limits have to match the local reality.
Exactly. They differ hugely across California, precisely because property values are so incredibly different from place to place.
And we see that stark contrast, right? High cost spots, LA, Orange County, parts of the Bay Area. The limits there have to be way higher than somewhere more affordable, like Fresno or maybe Riverside.
Absolutely.
Mm.
And this number, this limit, it's not set in stone forever. The Department of Housing and Urban Development, HUD, they update these limits every single year.
Every year. Okay.
Yeah, they look at national home price data, local home price data, and they adjust the limits to try and keep pace. It's all about maintaining that accessibility goal.
Which brings us neatly to the future, 2025. Given how California real estate just keeps appreciating, what's the feeling? What are we expecting for these FHA limits next year? Another big jump.
Well, based on the trends we're seeing, the expectation is that FHA loan limits in California will likely increase, probably modestly in 2025.
Modestly.
The system is designed to follow the market.
Mm-hmm.
So if house prices keep going up, which, let's face it, they are in California,
Right.
then the limits have to rise too. Otherwise, the FHA program starts to become less relevant in those expensive areas.
Okay, let's talk actual numbers. Brass tacks. What are the key dollar amounts you should maybe start thinking about for next year?
So for listeners in the most affordable parts of California, the areas HUD designates as low cost.
Hmm.
Well, the FHA limit for a single-family home might land somewhere around $498,257. That's the projection.
Okay, almost $500,000, that's a solid baseline. But for someone listening in, say, LA or the Bay Area, that number just isn't going to cut it, is it?
No, not at all. It needs to be much higher there, and it is. In those highest cost counties, think Los Angeles, San Mateo, Orange County, the maximum FHA limit, the absolute ceiling, is projected to potentially reach up to $11,149,825.
Wow, okay. Nearly $1.15 million.
That's the ceiling, yes.
And that high number is so critical, isn't it? Because it directly enables these bigger renovation projects we're talking about. Why does that specific high limit matter so much for the homeowner who wants to renovate?
Because renovations add up incredibly fast, especially here in California, with labor and material costs being what they are.
Tell me about it.
So imagine you buy a place for, say, $900,000. And you need to do a $200,000 renovation, maybe a full kitchen overhaul, add some energy-efficient upgrades. Your total cost hits $1.1 million.
Right.
Without that high FHA limit, you'd probably have to finance that in two chunks. You'd get your main mortgage, and then you'd need a separate loan for the construction, probably at a higher interest rate.
Which could make the whole thing unaffordable.
Exactly. These higher FHA limits let you potentially wrap it all together. One loan, one closing, insured by the FHA. It keeps things simpler and potentially more affordable.
That consolidation sounds key. And maybe a quick strategic point here, since HUD updates these limits officially every year. If you're planning something right now and you think you might be close to the current 2024 limit,
Uh-huh.
you should probably factor in this potential 2025 increase when you talk to your lender, right? Timing could matter.
Definitely. Timing is crucial. And look, that rising FHA limit, it doesn't mean much if you don't have the right tool to actually use it for renovations.
Right.
You can't just tack renovation costs onto a standard FHA purchase loan. That's where this home renovation loan FHA, the FHA 203K loan, comes in.
Okay, this is where it gets really interesting for people wanting to upgrade. The 203K isn't just a regular mortgage, it's like a specialized vehicle. Explain its main job for us.
The 203K is pretty clever, actually. It simplifies things hugely by rolling both debts, the cost of the house and the cost of the repairs, into one single mortgage loan.
One payment.
One payment, one closing. It's perfect for that older house that needs updating, the classic California fixer-upper. But, and this is important, the simplicity comes with its own set of rules and administrative steps you really need to know about up front.
Okay, let's get into that. I understand there are two main types of 203K, the standard and the limited. And the difference isn't just the amount of money, but also how much paperwork and oversight is involved.
That's exactly the crucial point. The limited FHA 203K loan, sometimes called the Streamline, is for smaller jobs, specifically projects costing under $35,000.
Under 35K. Okay.
And critically, it's for non-structural work. Think kitchen updates, new floors, paint, maybe bathroom remodels, cosmetic stuff mostly. Because the work is less complex, the paperwork and oversight are much lighter, less bureaucracy.
But if your project involves anything structural, like adding a room, repairing the foundation, maybe moving walls that hold up the roof,
Yep, load-bearing walls.
then it automatically becomes a standard FHA 203K loan, right? Even if the cost is less than $35,000.
That's correct. Structural work always pushes you into the standard 203K. And this is where the logistical complexity really increases.
Why? What does the standard loan add?
Because the risk is higher with major structural changes, the standard 203K requires much more oversight. The two biggest administrative hurdles you'll face are the mandatory FHA consultant and something called the draw process.
Okay, let's take the consultant first. Who are they? What do they do?
The FHA consultant is basically the project watchdog and inspector. They're required for the standard loan. They have to create a detailed work write-up, they review your contractor's bids, and they make sure all the planned work meets FHA's minimum property standards.
So they're checking the plans.
They're checking the plans, and they're making sure the house will be safe and sound after the work is done. They're protecting the value of the property, which is the FHA's collateral, during construction.
Okay. And the draw process. That sounds like how the money actually flows.
It is. It's very controlled. When you close on a standard 203K, the money set aside for the renovation doesn't just go to you or your contractor in a lump sum.
No.
No. It goes into a special, protected renovation escrow account. Your contractor then gets paid in stages or draws, but only after the FHA consultant, or sometimes another qualified inspector, verifies that a specific phase of the work is actually finished, and finished correctly.
So the consultant isn't just reviewing plans, they're actually inspecting the work as it happens and controlling the release of funds.
Exactly. They hold the purse strings, in a way. Funds only get released after a satisfactory inspection confirms progress. It's the safeguard the FHA builds in for these bigger, riskier projects.
That is a critical detail for anyone planning a major remodel with this loan. You need to understand that payment schedule and inspection process.
Absolutely. Okay, so now let's connect this whole mechanism, the 203K loan, operating under that potentially high FHA limit, back to your goals for a 2025 project.
Right. So what does this combination, the high limit plus the 203K structure, actually mean for you, the California homeowner planning renovations? We identified 4 key advantages, right?
Yeah, 4 main benefits stand out. First, and maybe most obvious, is increased borrowing power. Especially in those super high-cost California counties, being able to finance projects potentially up to that, $1.15 million ceiling means you don't necessarily have to raid your savings or rely on things like high-interest credit cards or personal loans for the renovation part.
Keeps it all bundled.
It keeps your total housing debt consolidated and hopefully more affordable. Second big advantage, flexible credit and down payment requirements.
That's what FHA is known for.
Exactly. FHA loans are generally more accessible. They often allow borrowers to qualify even with credit scores that aren't perfect, and the down payment can be as low as 3.5% of the total acquisition and renovation cost. That's huge for, say, first-time buyers or people just moving to the state.
Okay, number three is that streamlined approach we talked about, combining the purchase or refinance and renovation costs. One loan, one monthly payment, one set of closing costs, much simpler than juggling multiple loans.
Right. And the fourth benefit, which is really crucial in a market like California's, is stability amid rising costs. The fact that HUD does review and adjust these county limits every year,
Hmm.
it ensures that this federal support mechanism tries to keep pace. It helps keep home ownership and, importantly, necessary home improvements accessible, even as living costs and especially construction costs just seem to climb relentlessly here.
Yeah, that annual adjustment is key. Which leads us to some strategic advice that came up in the sources. When you're planning a project using a 203K, you really need to focus on upgrades that will tangibly increase your home's appraised value, not just, purely cosmetic or luxury choices.
That's exactly right. Remember, the FHA is insuring the loan based on the future value of the home after the renovations are complete.
The after improved value.
Precisely. So when you're planning, you should prioritize things that appraisers typically value highly. Think about a new roof, a modern kitchen renovation, maybe adding energy-efficient windows or systems. These types of improvements are much more likely to meet FHA guidelines and ensure your investment directly boosts your long-term equity.
Good practical advice. Focus on value add improvements. Okay, before we wrap this up, just for context, let's quickly position the FHA loan against the other main options people might have, say conventional loans and VA loans. How does FHA stack up?
It really boils down to trade-offs based on your situation. FHA loans, as we said, are government-backed. They're built for accessibility, meaning they can often accommodate borrowers with maybe lower credit scores or smaller down payments.
Okay, sounds good. What's the catch? What's the cost for that flexibility?
The main cost is mortgage insurance premium, or MIP. It's mandatory on FHA loans. Unlike conventional loans, FHA usually requires both an upfront MIP payment and an ongoing annual MIP, which for many borrowers today lasts for the entire life of the loan. That adds to your monthly cost.
Okay, so FHA has MIP. How does that compare to conventional?
Conventional loans are different. They aren't backed by the government directly. Because of that, they generally demand higher credit scores from borrowers. And critically, you usually need a larger down payment, typically 20% if you want to avoid paying private mortgage insurance, or PMI.
So PMI is the conventional equivalent of MIP.
Sort of, yeah. But with conventional, if you can put down 20% or reach 20% equity later, the PMI usually goes away. With FHA's MIP, it often sticks around. So if you have strong credit and can manage that 20% down, the conventional loan path is often cheaper over the long haul.
Got it. And what about VA loans for veterans and service members?
VA loans are, well, fantastic if you're eligible. They're government guaranteed specifically for veterans, active duty personnel, and some surviving spouses. Their huge advantages are typically zero down payment, required 100% financing, and usually no ongoing mortgage insurance.
Wow, zero down and no MI.
Yeah, it's a powerful benefit earned through service. And what's particularly interesting for our discussion about California renovations, VA loan limits also adjust based on county housing costs.
Ah, like FHA.
Right. And often in these really high-cost California counties, the VA loan limit for qualified borrowers in 2025 might actually exceed that FHA ceiling of $11,149,825.
Oh.
So for eligible folks, VA could offer even more borrowing power for a purchase or a renovation project.
Okay, that's a really important distinction for anyone eligible for VA. Good context. So this has been a real deep dive, I think, into the financial machinery you might need to tackle a California remodel in 2025.
Yeah.
To kind of wrap it up, those projected 2025 FHA loan ceilings may be hitting close to $1.15 million in high-cost areas. Combined with the structure of the FHA 203K loan, especially the standard version, it offers a pathway, a secure single mortgage path to improve your home. The real key, though, seems to be understanding the nuts and bolts of that standard 203K process. The role of the FHA consultant, how the escrow account works, that draw process for payments, getting those logistics right is crucial for a smooth project.
Absolutely. The program is literally designed to help homeowners keep up with rising costs and build value. But maybe let's leave you, the listener, with a final thought to chew on.
Okay.
We've talked a lot about how these FHA limits have to keep adjusting upwards every year just to keep pace with California's crazy housing appreciation. The government steps in to ensure the program remains accessible.
Right, it's a necessary adjustment.
But think about the implication. What does the necessity of this constantly rising federal limit really tell us about the long-term health, the sustainability of the overall California housing market?